Hey, what's up, everybody? It's Mr. White here with your final test review for K-Level Economics. So go ahead and get out that blue test review paper and follow along as we go over all the answers to your test review about Unit 6, which is all about personal financial literacy. Okay, the first topic you need to know about is banking and investing. And the very first thing it wants to know is, what is the FDIC? Well, the FDIC stands for the Federal Deposit Insurance Corporation. This is basically government insurance that covers your checking account or your savings account for up to $250,000. That's $250,000. What that means is if the bank were to close down or go out of business or get robbed and they lose all your money, the federal government will replace every single dollar in your account up to $250,000. So of course, if you're a millionaire, you probably want to have more than one account. That way, if anything goes wrong, your money is insured. This is one of the reasons why banks are the safest place to put your money. Next up is a checking account. Remember that a checking account is just a highly liquid account. It's a really safe place where you can put your money, and it allows you to write checks, use ATMs for cash withdrawals, and of course, you can even purchase items online or in stores with your debit card. So it's a very flexible account that gives you access to your money when you need it. Now, whenever you have a checking account, something you have to be really careful about is that you don't spend more than what's available in your checking account. Sometimes if you write a check for greater than what's actually available in your balance, you'll be hit with what's called an insufficient funds fee, or an NSF fee. Insufficient funds means that you've overdrafted your checking account. Overdraft means you've pulled out more than what's actually available. Now, the bank is going to cover the charge initially, but then they're going to charge you for it. So you're going to have to pay a fee to the bank, and you also have to pay back the amount of money that you overdrew your account. Now, some checking accounts help you protect against this by offering something called overdraft protection. Generally, what it does is it just takes money from your savings account or your credit card to cover the extra amount of money that you accidentally spent. That way you don't have to pay any extra fees, and your account basically just goes to zero. Now, when we talk about principal, we're not talking about Ms. Hardy or Mr. Pham. We're talking about the initial amount of money that's invested or lent. So in other words, if you got a loan, the amount of money you borrowed is the principal. Or if you put your money into an investment like the stock market, the initial amount of money that you put into the stock market is what we call the principal. So for example, if Jose invested $10,000 in a certificate of deposit, which is a type of high-end savings account, $10,000 is what we would call the principal. Now, over time, Jose will earn interest on the principal he invests. So for example, if Jose's certificate of deposit pays 5% interest, that means that Jose is going to earn 5% of $10,000 over the time that his money is invested. Okay? Now, the last thing is bankruptcy. Definitely not something any of us ever want to go through. Bankruptcy is what happens when you get in over your head with debt and you can't legally repay your debts. So bankruptcy is legal protection you get if you can't repay your debts. Essentially, you have to repay what you can afford to repay, and they'll forgive the rest of your debts. But the problem is that it tends to ruin your credit for approximately 7 years. So it's not something that you should do just willy-nilly. It's something that you really would only want to do if you're in serious, serious trouble and can't pay your debts back. Okay, types of investments. Well, when we talk about investing, essentially what we're saying is ways to let your money grow. Now, whenever you let your money grow, the whole point is that you want to earn interest. In economics, the term we use is yield. I know that's not on your test review paper, but you would want to know this term because you're going to hear me say it a couple times. And honestly, as an adult, you'll hear other people say this. I don't want you to feel dumb and not know what they're talking about. So the yield of your investment is how much profit you're going to earn from your investment. And you're not allowed to get that profit until your investment matures. So in terms of investing, the word maturity means the due date when an investment must be repaid with interest. So we talk about this a lot when we discuss government bonds. Government bonds will mature at a specific date, at which point the government has to pay you back the principal that you invested plus your interest. Now, the most simple kind of investment is a savings account. You see, when you put your money in a savings account, that is actually a low yield, low risk investment option, meaning that you're not going to get a lot of profit from it, but you're also not taking much risk. The reason why is because it's liquid. You can actually pull the money out when you need it. and that's good in case you have an emergency. Now, a money market account is different. A money market is also a low yield, low risk investment option, but the difference is it's liquid like a savings account, but it earns slightly more interest than a traditional savings account. And the reason why is because some of your money gets invested in the stock market. So assuming that the stock market is doing well, you'll actually have a higher yield on a money market account than you would on a traditional savings account. Now, a certificate of deposit is another type of savings account, but it's what we would consider a high-end savings account. It is a medium yield, low risk investment option. Essentially, it's going to give you a lot more interest than a money market or a savings account. You know, if a money market or a savings account is giving you maybe 1 or 2% interest, a certificate of deposit might offer you like 4% interest. But the catch is you cannot access your money until your certificate of deposit matures. So if you get a certificate of deposit that matures after a year, that means that you cannot pull your money out until 1 year has passed. If you try to pull it out before then, there's going to be lots of penalties and fees, and it's going to mean that you're going to actually lose money. So in that way, I guess you could say a certificate of deposit is slightly more risky, but that's because you cannot access the money if you have an emergency. Now, a savings bond is different than a savings account. A saving bond is a type of investment where you're basically buying government debt or debt from a corporation or some other kind of agency. It's going to pay a fixed amount of interest upon maturity. Sometimes we call these government securities, okay, or just securities for short. The yield and the risk of a bond really depends on its security rating. So in other words, if it's a highly rated bond like a AAA bond, the yield is usually going to be pretty low, but that's because the risk level is very low. If it's a low rated bond like a C or a D rated bond, the yield will be very high, but good luck collecting that yield. The reason why a bond would have a C or a D rating is because they've already had an instance where somebody was owed money and they did not pay back the money with interest. So that means that the chances of you getting paid back with interest are actually pretty slim. Now, the stock market is the most risky place to invest your money. Investing in stocks is a high yield, high risk investment option. Basically what you're doing is you're becoming a partial owner of a corporation. And so if the corporation does well, you'll make money. But if the corporation does poorly, you're actually going to lose money. And with the stock market, there is no guarantee of profit. As a matter of fact, most of the time when people put their money into the stock market, they gain a little, but then they lose a little, and so the yield can actually be very volatile. You don't always know how much money you're going to get when you invest in the stock market. Now, the last thing is a mutual fund, which is a slightly safer way to invest in the stock market. I would say that this is a medium yield, medium risk investment. So when you get a mutual fund, you're investing your money into an account that takes your money and divides it up into a variety of different stocks and bonds. So in that way, you're not just buying the stocks of one company, you're buying the stocks of dozens of companies. What that does is it spreads around your risk, and it makes it so that if one company has trouble, you're not going to lose all of your investment. Now, generally, mutual funds are managed by a professional financial advisor, somebody who studies the stock market for a living and can help you make choices about what stocks are going to go into your basket. So I guess if we're going to talk about baskets, we could use that old adage that you don't want to put all your eggs in one basket. That's what a mutual fund allows you to do. It allows you to have lots of eggs in lots of different baskets instead of all your eggs in one basket. Now, we were talking about bonds, so let's just get into what types of bonds are available. There's actually 4 major types. The kind that we've talked about already, and we discussed this when we were studying monetary policy, are U.S. Treasury bonds. U.S. Treasury bonds are government debt issued by the U.S. federal government. They're also known as Treasury securities. So if you ever hear that term or see that term, don't be thrown off. Treasury securities and Treasury bonds are the same thing. Generally, the government will issue these bonds if they have some sort of government spending they want to do. Remember, we said that's something they would do during expansionary fiscal policy, like if the government wanted to build more airplanes for the Air Force. Generally, they don't have enough money to do that, and so they'll issue out a bunch of these IOUs to get the money they need to build more airplanes for the Air Force. As a matter of fact, this is how we funded the war effort during World War II. Hey, maybe you remember learning about those U.S. government bonds that were advertised during World War II, right? They were called war bonds. Now, a corporate bond is different. Corporate bonds are debt that's issued by a corporation, like, for example, McDonald's. Now, These bonds can be safe or risky depending on the credit rating of the corporation. Generally, businesses would issue bonds if they want to get money to help their company grow, but they don't want to borrow the money from a bank. Instead of borrowing it from a bank, they just issue out a bunch of IOUs and borrow it from individuals like me and you. Now, a municipal bond is something that's issued by a local government, like Cy-Fair ISD. Okay, these bonds are used to fund municipal projects or new construction. A great example is the two new high schools in our district, Bridgeland and Cy Park. Those two high schools were very, very expensive to build, and the school district didn't just have money laying around to build them. What they had to do was issue a bunch of Cy-Fair ISD bonds, basically Cy-Fair ISD debt. And investors all over the world buy that debt, and that's how Cy-Fair was able to pay for these two new schools in our district. Now, the last thing is an agency bond. This is debt issued by a government agency, like, for example, the Department of Homeland Security. This is also used to fund specific projects or other kinds of agency expenses. So if the Department of Homeland Security needs drones to monitor activity along the border, that would be something they might have to sell bonds in order to be able to purchase. The stock market is another place where a lot of people invest their money. And some terms you need to know about the stock market are, first of all, dividends. I know there was some confusion about dividends on the worksheet we did about the stock market, so please allow me to clear that up. Dividends are simply monthly payments that a corporation makes to holders of their preferred stock. Essentially, this is money that they pay you just for owning their stock. With normal stock, or what we call common stock, you actually have to sell your stock to get money. But with preferred stock and dividends, you don't have to sell your stock. As a matter of fact, the way you get paid is just for keeping the stock. So as you might imagine, it's kind of hard to get your hands on preferred stock because most people don't want to give away an opportunity to get money for nothing, essentially. Now, preferred stock, like I was saying, is stock that entitles you to a portion of the company's profits, which are paid out in the form of dividends. So what's cool about preferred stock is that you're going to get paid first. But the downside of owning preferred stock is that you don't get any voting rights in company decisions. Now, the other kind of stock, the kind of stock that most people buy, is what's called common stock. Common stock does not pay a dividend. As a matter of fact, if you want to get money from your common stock, you actually have to sell it. But the nice thing about common stock is that it gives you voting rights when it comes to important company decisions. For example, if the company was going to elect a new president or CEO, you would actually have a vote over who you think should be the next president or CEO of that company. So that's common stock. Now, you've also heard the term bear market and bull market. A bear market means that investors are feeling pessimistic and stock prices are falling. Generally, this is not good for the stock market, so nobody really likes a bear market. Instead, everybody likes a bull market. As a matter of fact, that's the reason why this brass bull statue is standing out in front of the New York Stock Exchange. Maybe you've seen it before on movies, or heck, maybe you've been to New York and seen it yourself in person. If you ever wondered why is there a bull in front of the New York Stock Exchange, it's because a bull market signifies that investors are feeling very optimistic and that stock prices are rising. So this is what every investor wants. Every investor wants to see the stock market rising because that means everybody's making more money. Now, when we make money from selling stocks or from getting dividends, that's what's known as a capital gain. But if you lose money from selling stocks, that's what's known as a capital loss. Okay? So let's move on and talk about some other things. For example, taking control of your own money. Now, one thing we learned about is something called a FICO score. FICO score stands for Fair Isaacs Corporation score. This is also known as your credit score or your credit rating. So if you've ever seen websites and commercials like Credit Karma, what they're talking about is a way for you to check your FICO score to see if you have good credit or bad credit. Now, liability insurance is something that could be affected by your FICO score, but basically what liability insurance means is insurance that just covers damage done to other people's property, not your own property. So if all you have on your car is liability insurance, what that means is that if you got into a car accident, your insurance is going to pay for the damage that you did to the other person's car, but it's not going to pay for any of the damage that's done to your car. This is actually the minimum level of insurance that every driver in Texas has to have by law. So if you're out there on the roads driving a car, you absolutely have to have liability insurance at the bare minimum. Now, Renter's insurance is another kind of insurance, and it is exactly what it sounds like. It's insurance that covers your personal property in the event of something like a robbery or a fire or any other kind of disaster that may befall your home or apartment that you rent. Most people don't think this is important because they think, oh, well, you know, if I'm in an apartment and the apartment complex burns down and all my stuff gets burned up, the apartment complex will pay for my stuff. That's absolutely not true. The apartment complex won't pay for anything. You have to have renter's insurance if you want your stuff to get paid for. So that's why it's a really smart idea when you get out there in the world and you have your first apartment, please, please, please get renter's insurance. It's really not that expensive. It's maybe like $10 a month. And if you ever had a disaster happen to your apartment, it's going to be a way that you can get all your stuff paid for so that you can get back up on your feet again. Now, I think everybody should know what FAFSA is by now. Okay, that's the free application for federal student aid. Remember, it opened back at the beginning of October. Hopefully you've heard back from them by now. If not, hey, just sit tight. They're getting back to people. But basically, FAFSA just means all the forms you have to fill out in order to be eligible to get financial aid to go to college. So unless you're independently wealthy and you can just pay for college yourself, you're going to need to fill out FAFSA. Now, a mortgage is the biggest loan that most of us will ever take out in our lives. A mortgage is a loan that's used to purchase a home. Now, when you have insurance, you're going to have to pay something called a premium. The premium is the monthly payment that's due on your insurance policy. So for example, if you pay $175 a month for car insurance, you could say that your car insurance premium is $175 per month. Now, the last thing here, whenever you get your car insurance, not only will you be responsible for paying a premium, but you're also going to have to pay something called a deductible in the event that you make a claim on your insurance. The deductible is the portion of your insurance claim that you are responsible for paying out of your own pocket before the insurance company will pay anything. So for example, imagine that your car insurance has a deductible of $1,000. Then you get into a car accident and the total cost of your car repairs is $1,100. What this means is that you personally must pay $1,000 out of your own pocket before the insurance company will pay the last $100. So this is the reason why, if you're somebody who doesn't have a lot of extra money laying around, you want to make sure that you have an insurance policy with a low deductible. That means that if something goes catastrophically wrong, you won't have to come out of pocket very much before the insurance company will start paying. However, if you're somebody who's got a lot of money saved up and it's not that big of a deal for you to pay a large deductible, it's probably smarter to make sure that you choose an insurance plan that has a low premium. Low premium means you're not going to pay very much per month, and overall it'll save you some money. So whenever you're choosing an insurance policy, generally, if the premium is very high, the deductible is very low. But if the premium is very low, generally the deductible is very high. So that's something you need to take into consideration when you're shopping for insurance. Okay, so we were talking about the stock market earlier, and it's really important for you to know how to read a stock market table. If you just take a look at this table right here, we've got a couple different things going across the top. All the way to the left, you see the 52-week high and the 52-week low. That tells us the highest price and the lowest price that the stock traded for throughout the year. Hopefully you remember there's 52 weeks in a year. Now, it tells the name of the company, so we got Exxon, Disney, and Ford. Right next to that, DIV stands for dividend. Remember, we said dividend is the money you get paid just for owning a share of the stock. So for Exxon, people who own their preferred stock get $1.60 per month for every share they own. People who own Disney get 44 cents per month for every share that they own. And people who own Ford get $3 a month for every share that they own. That's their dividend. So if somebody owned 3,000 shares of Ford stock, that would mean they would get paid $9,000 a month by Ford just because they own the stock. That's their dividend. Now, volume. That tells how many shares of the stock were traded that day. You actually have to multiply that times 100 to get the actual number. Now, the high says what was the highest price the stock sold for that day. Low means what was the lowest price the stock sold for that day. And then close says that at the end of the day when the market closed, what was the final price that that stock traded for. All the way to the right where it says change, that tells us whether the stock price went up or down over the course of the day. So you can see that Exxon went up by $1.28, Disney went down by 95 cents, and Ford went up by 52 cents. So let's answer a couple questions now. First of all, how many shares of Ford were traded on this day? Well, what we would need to do is come right over here and look where the volume is. So I'm circling it for us now, okay? 54,861. We need to multiply that times 100 to know how many shares were actually traded. So 54,861 times 100 is equal to 5,486,100. So that means that there were 5,486,100 shares of Ford stock traded that day on the market. Now, next up, did Disney's stock price increase or decrease from the day before? What we want to look at is over here at the change. Since we see that Disney stock price went down by 95 cents, we would say that the price of Disney stock has decreased from the day before. Now the last thing, if you initially bought Exxon stock for $25 a share and then decided to sell all of your shares today, would you have a capital gain or a capital loss? Take a look at Exxon and see what it traded for at the close of today's market. The closing price was $36.49. $36.49 is higher than $25, so we would say that if we sold our shares, we would have a capital gain, meaning that we would have earned money from selling our stock. All right, next up, banking and investing, a couple terms you need to know. First of all, you need to know the functions of banks. There's three major functions that banks have. First of all, banks provide checking accounts to give customers a secure way to store cash and be able to access it on demand. This is why sometimes we call checking accounts demand deposits, because you can deposit your money and then pull it out whenever you want. Now, they also provide savings accounts for customers. These savings accounts are also a secure way to store your money, and the best thing about savings accounts is they actually pay you a small amount of interest every year. Last up, banks are responsible for issuing loans to individuals and businesses. This helps keep our economy going. You may remember that loans are a major part of fiscal policy because they put more money out into circulation. Now, what is the safest security rating for bonds? This is something you would need to know, especially if you want to invest in bonds. Any bonds that carry a AAA through BBB rating are considered the safest bonds. Usually we refer to these as investment grade bonds because if you're looking for a good place to invest, a bond that has a AAA through BBB rating is a good place to invest. A great example is that U.S. Treasury securities are currently AAA rated, which means that if you put your money into a U.S. Treasury bond, your money is extremely safe. Anything from BB through DDD are considered the most risky kinds of bonds. The nice way to say it is a high yield bond, but most people refer to these as junk status bonds. The reason why they'd be called high yield is because the only way anybody will buy these bonds is if they offer a really high interest rate. Generally, AAA and BBB bonds don't offer high interest rates because they're so safe. Like U.S. government bonds only offer 2% interest. However, if you were to buy bonds from someplace like Mozambique, Mozambique has a D-rated treasury rating or a D-rated bond. So that means that Mozambique is probably paying 7 or 8 or 9% interest on their bonds. The reason why is because currently right now Mozambique is in default. Default means that they haven't paid back their investors. People already lent money to them and haven't gotten paid back. Okay, credit and loans. So what are the 4 C's of credit? That's something you got to know. The first C of credit is capital, right? The total value of all the assets and property that you own. The second C is collateral, valuable assets that the bank could seize from you if you fail to pay back your loan. Like for example, if you own a car and you get a car loan, you don't pay your car loan, that's when they send the repo man. Now, capacity, that means your regular income and earning potential. So in other words, if you're somebody who works at Walmart, nobody's going to loan you $1 million because you don't really have the capacity based on your income and earning potential to ever pay back $1 million. And the last thing is your character. In other words, your trustworthiness, your stability, and your overall credit history. So if you've got a track record of always paying your bills on time, we'd say you have good character and more likely to get credit. However, if you're somebody who has lots of late bills or bills that haven't been paid, then you're not going to be looking as trustworthy, and therefore fewer people will give you a loan. Okay, that's most of what's on the test, guys. Now's your chance to ensure that you're going to get at least 10 points by doing your short answer. Okay, I'm not going to give you the answers, but I'll at least walk you through it and tell you what you need to look at to be able to get the right answers. So it says Sophia recently graduated from the University of Texas with a bachelor's degree in economics. 2 weeks after graduation, she landed her dream job of working for ExxonMobil as an economic analyst. Her new job will pay a pre-tax salary of $100,000 per year. Sophia wanted to buy some professional work clothes before beginning her new job. And since she didn't have a paycheck yet, she had to buy the clothes on her credit card, which charges an annual interest rate of 20% on all outstanding balances. Ooh, that's a high interest rate. So, first thing we need to know is how much will Sophia pay in federal income taxes this year? What you need to do is look right over here. You see I'm kind of making a little thing on your chart, okay? And find where Sophia's income is at. Once you find Sophia's pre-tax income, you'll see what her tax rate is. Oh. Now, once you know Sophia's tax rate, what you have to do is figure out what percentage of 100,000 would that represent. So in other words, if it's 25%, what's 25% of 100,000? I know that's a brain buster, but think for a minute and you'll figure it out. Okay, next up, how much will Sophia earn from her salary after taxes? So once you know how many taxes she's going to pay, you take that amount, subtract it from 100,000, whatever you get is how much money she'll have left over that's going to be her spendable income. Now, if Sophia earned a Christmas bonus of $3,000, will her tax rate change? Explain your answer. Well, we know how much she was making before taxes. Keep in mind a Christmas bonus is extra money on top of her pre-tax income. So if you add 3,000 to 100,000, you got to ask yourself, would that put her into a different tax bracket? It just might. It just might. I don't know. It's possible. Now, if Sophia wanted to invest money, but she's not willing to take any big risks, what kind of investment options should she pursue? Well, we've talked about lots of investment options. If you just rewind the video a little bit, you can see. Think about some of those investment options that I said are low risk and low yield, or possibly even medium risk, medium yield. All you got to do is just choose one of them and explain to me why that would be a low risk option for her to invest her money. And then the last thing, when Sophia's credit card statement arrived at the end of the month, her balance was $273.46. That was for all the clothes that she purchased, remember? Now, the minimum payment due is only $13.67. Ooh, that's really tempting. But what do we say? It's a trap. Now, Sophia can afford to pay the entire balance. I mean, she's making good money, right? But she's thinking of paying just the minimum because $13.67 is really tempting. Now, would you advise her to pay the minimum or some other amount? Tell me what you think she should do and then explain why you think she should do that. If you can answer all 5 of these questions, you'll get 10 points on the test. And guys, I mean, come on. This is easy stuff. There's no reason why you shouldn't be able to answer these questions, especially if you just did the personal finance project. This is basically the same thing. Come on, easy. So please take your time, study this, go over this again. You might even need to look at it 1 or 2 more times before you come in and take the test. Of course, if you have any questions, you can ask me before we take the test. Otherwise, guys, good luck.